Hi everyone, I'm Bagadon of Stock Market Caddy, and you are looking at our product called the SMC Doppler Sentiment Radar, as in a Doppler weather radar. This gives us at a very quick glance what is going on with our futures markets here in the States, and this is a problem, folks. You see the VIX. The VIX is a contrarian indicator, and they are panic selling the VIX, the volatility. They are not interested in buying any puts. They've been buying calls hand over fist, and they are driving the S&P, not so much the NASDAQ, the Russell and the Dow, into euphoria, a euphoric stage. This is a warning shot to our members. This is not where we want to buy stocks. In fact, and especially with the VIX over here, within a statistical expectation of 95%, we are more than likely over the next 30 days, we think sooner, that prices will revert back at minimum to the mean, toward the middle, and the same thing with the VIX. So we're anticipating a very sharp pullback very, very soon. Let me show you a couple of others. This also is something that we have built. You're looking at the swing machine. These are the yields on U.S. Treasuries, the yields. That is not 0.15. It's actually 0.015, 0.831, 1.607, and 2.368 on 90-day paper, 5-year paper, 10-year paper, and 30-year paper. What you're seeing is, and what we've been seeing, is a very sharp rise here in the States on yields from 5 years and out. In particular, the 10-year has nearly tripled, and the 30-year has more than almost doubled. The short end is virtually yielding negative when you factor in inflation. This graph matches or maps would be a better word, the spread between the 90-day paper and the 10-year. This shows us the steepness of the yield curve. This may be fine for the financials. It is not so fine for the real economy. We think we're going to have a very significant credit event soon. We think it'll manifest itself in a rise in short-term rates and a pull down in the long-term rates. And we very well could see some action out of the Fed, or it's going to come out of the market itself. But we're expecting a credit event. Let me show you one other little tool. We come here, this is the skew on the S&P. The skew is giving us a reading at 141, with the S&P at almost all-time highs. It is at all-time highs. If the big money were complacent, the skew reading should be below 120. It isn't. It's exactly the opposite. The last time we saw markets at its highs with a skew reading in the 140s was last February, where within 3 to 4 weeks we saw a 30% correction. What this means is the big money that they are selling calls hand over fist to the speculators, taking that money and buying puts, protecting themselves, hedging themselves. I'm Bagadon at StockMarketCaddy.com. If you want to know more about what we do, and by the way, let me just show you, because our systems we're not always bearish by any means. Let me just give you a view. Here are the daily futures. Our systems have been long the Russell for 113 days. 113 days. One mini contract purchased at this price at this time back on October 2nd, you'd be up 40 grand. We're still long the ES. We're actually short the NQ for the last 10 days. It's underwater a little bit. We think that'll resume back down. And then the Dow. So the trend is most definitely headed up, but we've come too far too fast, and we do expect to see a significant pullback at minimum. Good luck.